Okay, so we have to talk about the spread. We have a company that just delivered, some of its best operational performance in decades.
Absolutely.
Factories are humming, margins are up, they beat on the top and bottom line, and the market's response is to just erase 7% of its value in 6 hours.
Brutal.
You're holding 3M, that stings.
It was a really brutal session. I mean, you look at the volume, almost 12 million shares.
Right.
That's, 4 times the normal daily average?
Right.
That tells you this wasn't just, retail investors hitting the panic button.
No.
That's institutional money heading for the exits.
But that's the central mystery we've got to unpack here in this deep dive. Because on paper, if you just look at the Q4 scorecard,
It looks good.
it looks like the whole turnaround is working. And yet the reaction suggests the Bill Brown thesis, this idea that the new CEO can fix this industrial giant, is in real trouble.
So is it a broken story or not?
Exactly. Is the market seeing a crack in the foundation that the headline numbers are hiding? Or is this just, a case of investors wanting a sprint when they really bought a marathon runner?
It's that classic conflict, right? Operational reality versus what the market expects.
Yeah.
And we're looking at a company that is undeniably fixing its internal machinery, but the market just decided to punish the future outlook. So for everyone listening who tracks the industrial sector, the XLI watchers, this is a really pivotal moment to decide if 3M is a value trap. Or maybe, just maybe, a misunderstood compounder.
Okay, so let's hit that scorecard first. Just give us the so what on the headline numbers.
Okay, so adjusted EPS, earnings per share, came in at $1.83.
Which is a beat.
A solid beat against $1.68 from a year ago, yeah. Revenue was $6 billion and adjusted sales were up 3.7%.
Solid numbers.
They are. But the metric that really matters here, the one that tells you if the actual business is healthy, is the operating margin.
And that expanded.
It expanded to 21.1%. That's up 140 basis points year over year.
I want to pause there because margin expansion is a phrase that gets thrown around a lot.
Sure.
For a listener who doesn't track industrial conglomerates every single day, why is a 140 basis point jump such a big deal, especially right now?
Because we're in a low-growth world.
Yeah.
I mean, let's be honest. 3M isn't selling drastically more widgets than they were last year.
Right.
So if you can't rely on volume to drive your profit, you have to rely on efficiency. And that margin expansion proves they have pricing power, yeah, but more importantly, it proves they're stopping the leaks in the factory.
So they're squeezing more juice out of the same orange.
That's it, exactly. And that creates a kind of safety net. If sales stay flat because the economy slows, that margin expansion still allows earnings to grow. It's the proof that the internal self-help story is real.
Okay, let's get into that machinery. We're calling this segment the sharpened 3M. You keep bringing up these acronyms in your notes, OTIF, OEE. And to me, they sound like, middle management buzzwords that get put on a slide deck to make everyone feel busy. Does on time in full actually move the stock price?
It absolutely moves the cash flow.
How?
Well, think about it practically. On time in full, or OTIF, it just measures whether you ship the customer exactly what they ordered when you promised you would.
Simple enough.
But if you fail at that, customers don't pay the full invoice right away. Or worse, you have to spend a fortune on expedited shipping just to fix your mistake.
So bad OTIF burns cash.
It incinerates it.
Yeah.
And 3M ended the year with OTIF above 90%.
Wow.
That's up 300 basis points, and they've held that level for 7 months. That means their working capital isn't stuck in a warehouse or tied up in a customer dispute. It flows straight to the bottom line.
And what about cost of quality? That was another one that stood out.
That is the polite corporate term for waste.
Right?
It's the raw material that ended up in the trash instead of in a box. It's scrap, rework, yield loss. They cut that waste down to 6% of cost of goods sold.
That's 100 basis point improvement.
It is. So essentially, that's just free money they found lying on the factory floor just by tightening the bolts.
Incredible.
And they're targeting 4% over time.
Yeah.
So when you see them generating $1.6 billion in cash from operations in a single quarter, this is why. They're not throwing money away anymore.
So, okay. The factory is fixed, the cash is flowing, the machine is sharpened.
Yeah.
Why on earth did the stock crash on the 2026 outlook?
Yeah.
They guided for, what, 850 to 870 EPS? Mathematically, that's growth. Why did the market hate it so much?
It wasn't the number itself. It was the composition of the number. The street was pricing in a beat-and-raise rocket ship. They wanted to see all those efficiency gains drop straight to the bottom line, like immediately. They wanted acceleration.
But they didn't get that.
No, not at all. Instead, management told them that about 50 cents of that profit is just being eaten up by, let's call it messiness.
What kind of messiness?
You've got stranded costs from the Solventum spinoff. You've got tariff carryover impact.
Wait, let me play devil's advocate here. Is this actual messiness, or is Bill Brown sandbagging? Is he setting the bar really low so he can just step over it easily next year and look like a hero?
That's the billion-dollar question, isn't it? I mean, historically, new CEOs love to kitchen sink the guidance.
Right, throw all the bad news in early.
Exactly. So the comparisons look easy later. But the market isn't giving him the benefit of the doubt. Not yet. They see that 50-cent hit, specifically the $225 million in incremental investments, and they worry it's a structural cost, not a temporary investment.
Okay, explain that investment piece. What are they spending that money on?
Growth and productivity. So they're spending money to upgrade the plants, to fuel R&D, and the bulls say, great, they're investing in the future.
And the bears say?
The bears say, wait a minute, I thought you were cutting costs. Why are your expenses going up?
So it's a trust gap. The market sees a conversion story, turning sales into cash. But they wanted a massive growth acceleration story. And when you're trading at the multiples 3M had climbed to, steady just gets punished.
Exactly. And let's be honest, the legal overhang is still there. The whole PFAS litigation is a known issue, but it still muddies the waters. So when you combine steady but not explosive growth with significant one-time costs, it starts to look less like a turnaround play and, to the skeptics, a lot more like a value trap.
It feels like the market is just saying, show me the organic growth. And on that front, what are they guiding to? About 3% organic sales growth for 2026.
Which, to be fair, is better than the macro environment. The general expectation for U.S. industrial production is maybe 1.7%.
So they're planning to outgrow the economy.
They are. But 3% isn't the kind of number that gets momentum traders excited.
Let's break down where that growth is supposed to come from, because 3M is massive. It's practically a proxy for the global economy. And you've got this huge divergence in the report. The industrial side is holding up, but there's a clear anchor dragging the ship.
The divide is stark. The winners are clearly on the industrial and electronic side. The Safety and Industrial Group, SIBG, that was up 3.8% organically in Q4.
What's driving that specifically?
Well, aerospace is booming, obviously, we all know that. But what's interesting is that abrasives, sandpaper, grinding wheels, that accelerated. That tells you the industrial economy, the actual making of things, is holding up okay for them.
And electronics. I feel like everyone was worried about that sector going into the print.
It held up remarkably well. TBG transportation and electronics was up 2.4%. Despite all the fears about chip cycles, 3M's materials business there is it's sticky.
Okay, so factories are humming, planes are flying, chips are being made. Who is the loser here?
The consumer group,
Oh.
CBG, down 2.2% in Q4. And I think this is the part that really rattled investors. Management used the word subdued to describe the consumer.
Which is polite corporate speak for...
People aren't spending money.
But didn't they say December was up double digits? I saw that in the release.
Yes, but you have to read the fine print. That spike was driven by heavy promotions.
Oh.
They had to discount the product to move it off the shelf. And that protects your revenue line, sure, but it crushes your margins.
That's a great point. It's not like they're selling luxury handbags where you can maintain prestige. This is Post-its and Scotch tape and air filters.
Right.
And if people aren't buying air filters without a coupon, that says something about their wallet.
And the inventory tells the story, too. Channel inventory is normalized on the industrial side. Companies are stocking up again.
Right.
But on the consumer side, it's still elevated. Retailers are hesitant to stock up because they're not sure you're going to walk in and buy it.
Which brings us to the bigger picture. We have to talk about the macro environment 3M is swimming in, especially China. I feel like we always talk about China, but there was a specific nuance in this call about manufacturing shifting.
A watch item, to use their phrasing. China growth was actually good in 2025 overall. But Q4 saw a change. Smartphone manufacturing is starting to move out of China and into other parts of Asia. India, Vietnam.
That is a massive structural shift. That's not just a bad quarter. That's the whole map changing.
It is. 3M's supply chain was built to serve those factories in China. Now, they have to pivot their whole supply chain to chase those factories to new countries. And that friction, it hurts volume in the short term. You can't just move a chemical plant overnight.
Okay, so you have the manufacturing map changing, you have a subdued consumer, And you have flat industrial production. How does Bill Brown plan to grow 3% in that mess?
The pivot. They're aggressively moving the portfolio toward what they call priority verticals. These now make up over 60% of revenue. And they're introducing this new concept of design to cost.
Design to cost. That sounds like code for cutting corners or making it cheaper.
It can be, sure, but in this context, it's actually about survival. In a world where inflation is sticky, you can't just raise prices forever to cover your costs. Design to cost means engineering the product to hit a specific margin before you even start manufacturing it.
So it's value engineering.
Exactly. It's moving from make it cool to make it profitable. And if they can pull that off, that's how you get margin expansion, even when your sales are flat. It's a huge cultural shift for 3M R&D, which kind of used to just invent things and hope people bought them.
So the thesis really hinges on whether 3M can keep outgrowing the macro environment just through these self-help measures. They did it by about 60 basis points in 25. The gamble is, can they do it again?
That is the bet. You are betting on execution, not the economy.
All right, we have analyzed the wreckage. We have looked under the hood. Now it's time for the segment our lawyers love to hate. This is not financial advice.
Please, do not sue us. We are just reading tea leaves in a hazardous waste landfill.
Exactly. We are just two voices in your headphones. But if we were sitting on a hedge fund investment committee right now, looking at this 3M print, what's the trade? The stock's down to the mid-150s. Is this a value trap or is it on sale?
I'm calling this one the blue-collar bull, white-collar bear spread.
I like the sound of that. Break it down for me.
Okay. We know 3M's industrial side is working. The factories are efficient. The yields are up. OTIF is up. Bill Brown is fixing the blue-collar engine of the company. That stuff is real.
So you buy the dip?
So leg one is you go long 3M. You buy the dip aggressively because you believe the operational fix is going to generate cash regardless of what the headlines say.
You're betting the turnaround isn't broken.
Correct. But you've got a problem. The CFO explicitly warned us that the U.S. consumer is weak and retail traffic is soft.
Right.
That is a macro risk that could drag 3M down even if their factories are perfect.
So you need a hedge.
You need a white-collar bear hedge. You short a basket of pure-play consumer discretionary stocks, or you just buy puts on a consumer ETF like XRT.
The logic being, if the economy stays flat, Bill Brown's efficiency pushes 3M's stock up, so your long position wins.
Yep.
But if the economy tanks because the consumer collapses, your consumer short prints money and offsets the damage to your 3M position.
Exactly. You're trying to isolate the Bill Brown alpha, the operational improvement, while neutralizing the consumer beta, the risk that nobody buys anything. It's a way to play the internal turnaround without being exposed to the guy at the mall who just isn't spending money.
It's a bit of a pair trade for the industrial renaissance. You're betting on the manager, not the mall.
And honestly, with 3M at these levels, the downside on the long seems pretty limited compared to the potential upside if they actually hit that 3% growth target. But the consumer, that feels like a trap door waiting to open.
There you have it. The blue-collar bull, white-collar bear. Do your own diligence, please.
Absolutely.
So bringing it all back home, 3M is clearly a battleground stock right now. You've got solid Q4 execution versus a soft 2026 guidance. You have operational wins versus macro headwinds.
And you have a stock that's down 7%. You know, Wolf Research put out a note saying the story is not broken. And I tend to agree with the premise. The machinery is getting fixed. The question for you, the listener, is whether you have the patience to wait for this conversion story to play out.
Right. Is it a value trap that's just going to grind sideways for 2 years? Or is this a discounted compounder where you can buy a premier industrial asset on sale?
If you believe in the design to cost and the operational discipline, it's the latter. But you have to be willing to ignore the noise of a flat macro environment.
And that is the hardest thing to do in this market. Look, the 3M story isn't broken, but it is definitely under construction. We will be watching those OTIF numbers next quarter like hawks to see if the glue holds.
That's the canary in the coal mine.
All right, that is a wrap on the 3M Q4 deep dive. If you want to keep up with the industrial complex and deciphering these earnings calls, make sure you're subscribed to Talk Tickers. We have a very busy season ahead.
Lots of data coming down the pipe.
Markets close, but the conversation doesn't. We'll catch you in the next one.
See you then.